A janitor who invests $50 a month into one boring fund can end up richer than a doctor who actively trades his account for 30 years. That's not motivational fluff. That's math. And by the end of this video, you'll understand exactly why and which type of fund actually makes that possible for you. There are four major players in the fund world: index funds, mutual funds, hedge funds, and ETFs. They all sound similar. They are not the same. One of them is designed to make Wall Street rich. Another is designed to make you rich. Today, we're taking them apart, how they work, what they cost you in hidden fees, the strategies behind them, and step by step, how to actually buy them, whether you're in the United States, Nigeria, Kenya, South Africa, India, the Philippines, Singapore, or anywhere else in the world. Quick disclaimer before we start. This video is for education, not financial advice. Always do your own research or talk to a licensed advisor before investing. If this channel is about to save you thousands of dollars in fees over your lifetime, hit subscribe right now, because the next 10 minutes might be the highest value 10 minutes you spend all year. Picture 5 friends planning a road trip. Instead of each person separately renting a car, buying gas, and booking hotels, everyone throws money into one shared pot. That pot pays for everything, and everyone shares the experience without anyone carrying the full weight alone. That's a fund. A group of investors pool their money, and that pool gets deployed into stocks, bonds, real estate, or other assets. Instead of you personally researching and buying 40 different companies, the fund does it once, and you own a slice of the whole thing. But here's the part almost nobody explains. How that pooled money gets managed is the single biggest factor in whether you end up wealthy or whether you quietly fund someone else's yacht. That's the real difference between these four types of funds. Let's start with the one the internet won't stop talking about. You've heard it 1,000 times. Just put it in an index fund and forget about it. But what is an index actually? Think of an index as a scoreboard, a curated list of companies designed to represent a slice of the market. The S&P 500 tracks 500 of the largest U.S. companies, weighted by size, so giants like Apple and Microsoft move the needle more than smaller names. When people say the market is up today, they usually mean the S&P 500 is up. There are dozens of these scoreboards. The Nasdaq leans tech-heavy. The Dow Jones tracks 30 blue-chip industrial names like Coca-Cola and Johnson & Johnson. There are indexes for small-cap companies, emerging markets, bonds, real estate, even gold miners. An index fund's entire job is to copy one of these lists. No stock picking, no guessing, no fund manager trying to be a genius. It just mirrors the index. Here's the mind-blowing part most videos skip. Because the fund isn't trying to outsmart the market, it doesn't need a highly paid research team, and that's exactly why it wins. Nobel Prize-winning research on market efficiency has repeatedly shown that stock prices absorb new information almost instantly, which means beating the market consistently after fees is brutally hard, even for professionals. Roughly 90% of actively managed U.S. funds underperform their benchmark index over a 15-year period, according to long-running S&P, SPI, VA scorecards. So the boring approach statistically outperforms most of the smart money over time. The fee math that actually matters. Index funds typically charge an expense ratio between 0.02 and 0.20% per year. On a $10,000 investment, that's $2 to $20 annually. Compare that to a 1% fee, which sounds small but isn't. Over 30 years, a 1% annual fee can eat away roughly a quarter of your total portfolio growth, simply because that fee compounds against you every year, not just once. A detail almost nobody explains: how pricing actually works. Index funds are priced only once per day after market close using something called the net asset value, or NAV. That's the total value of everything the fund holds minus expenses divided by the number of shares outstanding. If you place a buy order at 11 a.m., you're not getting the 11 a.m. price. You're getting whatever the NAV works out to after the closing bell, typically around 4 p.m. Place your order before the daily cutoff time and it processes that same day. Miss it and you wait till tomorrow. It's not a flaw, it's just a different rhythm than trading a stock in real time. Major providers are Vanguard, Fidelity, and BlackRock's iShares brand. Warren Buffett has famously said that a low-cost S&P 500 index fund is what he'd recommend for the vast majority of investors, including instructing that a portion of his own estate be invested exactly this way. Mutual funds pool money just like index funds. The difference is who's driving. A mutual fund usually has a human fund manager, sometimes an entire team, actively deciding what to buy and sell, trying to beat a benchmark like the S&P 500. That expertise costs money. Expense ratios typically run 0.5% to 1.5%, sometimes higher, versus the near invisible fees of an index fund. Here's the mind-blowing stat that compounds against you for decades. If two people each invest $10,000 a year for 30 years and earn the same 8% average market return, but one pays 0.1% in fees and the other pays 1.5%, the low-fee investor can end up with well over $100,000 more from fees alone, not performance. The fund manager doesn't need to lose money for you to lose money. They just need to charge you every year while the market does its thing. That said, mutual funds aren't scams. They exist for real reasons. Some investors want exposure to a specific strategy, a niche sector, or a manager with a genuinely strong long-term record. Some retirement plans, like employer 401ks, simply don't offer index fund options, so mutual funds are the only door available. Just like index funds, mutual funds settle at end-of-day NAV. You place the order anytime, but it executes after the market closes. Major providers include Vanguard, Fidelity, and JP Morgan, many of whom offer both actively managed and passively managed mutual funds, so always check the fund's actual strategy before assuming. Now for the fund type most people will never touch, but everyone's curious about: hedge funds. The name hedge comes from the original idea of hedging risk. In practice, modern hedge funds are usually chasing aggressive returns using tools regular investors can't easily access: short selling, betting a stock will fall; leverage, borrowing money to amplify bets; and derivatives, contracts whose value comes from an underlying asset used to speculate or hedge. Hedge funds pool money from wealthy individuals and institutions, and because the strategies are high risk, access is legally restricted to accredited investors. In the U.S., that generally means an individual with over $1 million in net worth, excluding their primary home, or income above $200,000 for the past 2 years. This isn't gatekeeping for fun. Regulators require it because these strategies can blow up fast. The fee structure is legendary: 2 and 20, a 2% annual management fee plus 20% of any profits the fund generates. So if a hedge fund manages $100 million and returns 15% in a year, that's $2 million in flat fees plus 20% of the $15 million profit, roughly $3 million more. That's $5 million pulled out before investors see a dime of that gain. Here's the mind-blowing part. Despite the mystique, most hedge funds don't consistently beat the S&P 500 either. Multiple long-term studies, including data tracked by indexes like the HFRI, have shown that after fees, average hedge fund returns have often trailed a simple S&P 500 index fund over the past 10 to 15 years. Warren Buffett famously made a public 10-year bet in 2008 that an S&P 500 index fund would
outperform a hand-picked basket of hedge funds and won decisively. So why do they still exist? Because for large institutions, hedge funds aren't always about beating the market. They're often about reducing volatility, hedging against downturns, or accessing strategies like currency arbitrage that simply aren't available anywhere else. Finally, the fund type that's exploded in popularity over the last decade, ETFs, or exchange-traded funds. Think of an ETF as the hybrid child of a stock and an index fund. Like an index fund, it usually tracks a benchmark and pools diversified assets. But like a stock, it trades live on the exchange all day long. You can buy at 10:03 a.m. and sell at 2:47 p.m. at whatever the current market price is. No waiting for an end-of-day NAV. ETFs' expense ratios typically range from 0.03% to 0.75%, and many of the most popular ones, like funds tracking the S&P 500, sit near the rock-bottom end of that range. Many brokers now offer commission-free ETF trading, and some even allow fractional shares, meaning you can start with $5 instead of needing hundreds of dollars for a single share.
Here's a detail that separates a good investor from a great one: tracking error. Even though an ETF is supposed to mirror its index exactly, small costs and trading frictions mean there's often a tiny gap between the ETF's actual performance and the index it claims to track. When comparing two ETFs that track the same index, this, not just the expense ratio, is one of the details serious investors check before choosing one over the other. Let's put it all on one table mentally. Index funds, passively managed, ultra-low fees, priced once daily, best for hands-off long-term investors. Mutual funds, often actively managed, higher fees, priced once daily, best if you specifically believe in a manager's edge or need access through a retirement plan. Hedge funds, aggressively managed, very high fees, 2 and 20, restricted to accredited investors, best suited for large institutions and high-net-worth individuals seeking non-market strategies. And ETFs, usually passively managed, low fees, trades in real time all day, best for investors who want index fund-style diversification with stock-like flexibility. The uncomfortable truth Wall Street doesn't advertise: time in the market, low fees, and consistency almost always beat trying to be clever. That's not opinion, it's what decades of return data across fund types consistently show. This is the part most finance videos skip entirely. Here's how people around the world actually get started. For United States, open a brokerage account with a platform like Vanguard, Fidelity, Schwab, or a mobile-first app. Fund it via bank transfer, search for the ticker, like VOO or VTI for S&P 500 or total market exposure, and place an order. Many U.S. brokers now offer zero commissions and fractional shares, and tax-advantaged accounts like a 401k or Roth IRA are usually the smartest place to hold these long-term. For Nigeria, you can access both NGX-listed ETFs like the Vativa Griffin 30 or Stanbic IBTC ETF 30 and US-listed ETFs like VOO or QQQ through SEC Nigeria-regulated digital platforms like Bamboo, Chaka, Trove, and Meristem. You open an account, complete KYC verification, fund it in Naira or dollars, search for the fund, and buy units, all from your phone. For Kenya, for local exposure, you'll need a Central Depository System (CDS) account available through most banks and licensed stockbrokers to trade ETFs listed on the Nairobi Stock Exchange. For global index fund access, CMA-regulated platforms like Nadova let Kenyans invest in both local and international funds, funded easily through M-Pesa or bank transfer. For South Africa and broader Africa, the most straightforward way to invest broadly across the South African market is through ETFs tracking a South African index, available via licensed local brokers. For continent-wide exposure, a small number of ETFs specifically track a diversified basket of African stocks, accessible through international brokers.
For India, you'll need both a demat account, which holds your fund units electronically, and a trading account, opened together through any SEBI-registered broker. Complete KYC using your PAN, Aadhaar, and bank details. Then search for the ETF by name or exchange symbol. Popular choices track the Nifty 50 or Sensex. Prefer a hands-off approach without a demat account? Fund of funds schemes that replicate an index are also available directly through asset managers. For Singapore, open a brokerage account with a local bank broker or a global platform, fund it in SGD or USD, and buy ETFs like the STI ETF for local exposure or globally diversified options. Many MAS-regulated brokers now offer low-fee or commission-free ETF trading, and regular savings plans let you automate monthly contributions from as little as $100. For Philippines, for local exposure, FM ETF is the only ETF listed on the Philippine Stock Exchange, tracking the 30 companies in the PSEI index, purchasable through any PSE-licensed broker. For global diversification into U.S. markets, international brokers like Interactive Brokers are the most practical route for Filipino investors. The pattern across every country is basically the same. Pick a regulated broker, complete identity verification, fund your account, search the ticker, and buy. The interface changes. The math of compounding low fees over decades does not. Here's the thing that should genuinely blow your mind. The boring choice, a low-cost, broadly diversified index fund, or ETF, bought consistently over decades, has historically outperformed the majority of actively managed mutual funds and even the average hedge fund, after fees. Not because it's smarter, because it's cheaper, and because time does the heavy lifting when fees aren't quietly draining your returns every single year. Mutual funds can make sense if you believe deeply in a manager's edge or need one through your retirement plan. Hedge funds exist for accredited investors chasing strategies unavailable anywhere else. But for the overwhelming majority of people watching this video right now, an index fund or ETF bought consistently and held for years is the closest thing to a proven formula that exists in investing. If this video just saved you from years of paying fees you didn't need to pay, do 3 things right now. Hit subscribe so you don't miss the next one, drop a comment telling me which country you're investing from, I read every single one, and share this with the one friend who keeps asking you what an index fund even is. I'll see you in the next video. Until then, keep consistent, keep your fees low, and let time do what it's always done for patient investors.